They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
This man I'm about to talk about had a simple idea, an idea that blossomed into a beacon of hope for regular folks. He looked at the big banks and thought, why can't regular people join in too? So he started a new kind of bank called Vanguard. Before, only rich people could really be a part of these big banks, but now anyone could join in with Vanguard. Today, I will tell you the story of how this man's idea grew and grew until it became a big part of the financial world. And by the end, you will see how this one idea made it easier for everyone to save their money and watch it grow. So come along as we explore the exciting story of how a small idea can make a big change. If you've ever wondered how the giants of finance rise, today's story is a roller coaster of ambition and innovation. By establishing the first index fund in 1975, Jack Bogle, the founder of Vanguard, caused a paradigm shift in the world of investments. Bogle's method of creating low-cost, diversified index funds revolutionized the investment industry by setting the standard for efficiency and benefiting investors. This occurred despite the fact that Bogle's approach was initially met with skepticism. Warren Buffett once made the observation that Jack Bogle did more for American investors in general than any other individual he had ever known. Buffett went on to say that a lot of Wall Street is devoted to charging a lot for nothing. The Wellington Funds, which are mutual funds that the Wellington Management Company successfully manages, were the cause of a significant event that occurred at work that served as the catalyst for Vanguard's expansion. Bogle was asked to come up with a fresh plan by the board of directors at Wellington Management Company, which consisted primarily of Jack's loyalists from Philadelphia. Bogle was allowed to keep his position as chairman. To the chagrin of the Boston partners, Jack concocted a plan to mutualize the Wellington funds, which meant that the funds would eventually control the operational firm, which would eventually become Vanguard. This plan caused a great deal of consternation among the Boston partners. As a direct consequence of this, Jack assumed leadership of a fund accounting and registration firm that consisted of a meager 27 employees. Due to the mutual structure of the Vanguard funds, shareholders own shares, funds own Vanguard, and Vanguard makes no operating profit while serving the interests of its owners. When Jack says, "My goal was to create an enterprise that was only of the shareholder, by the shareholder, and for the shareholder," he is speaking literally because fund shareholders are Vanguard's customers. In the early years of Vanguard, when Jack Bogle was trying to make the mutual fund company more customer-oriented, he took additional risky actions. He did away with the common practice of paying brokers an advance fee of 8.5% in order to distribute funds, and he devised a strategy to go around middlemen and promote the company using the slogan "No Load," which means without commission. This marked the final occasion on which Vanguard was required to spend money on distribution. He delegated the management of his new funds to financial experts who were not affiliated with Wellington, so that he would not be wholly reliant on the company. The idea of a new fund that would replicate the performance of the S&P 500 index in the United States was met with skepticism and derision by the vast majority of those working in the financial industry. Vanguard's success, on the other hand, would ultimately depend heavily on Bogle's ability to lead the company. Bogle's common-sense investing philosophy for ordinary investors recommends low-cost diversified indexing, holding for the long term, avoiding market timing, not speculating, setting realistic expectations, and allowing the markets to do their job. These are all important tenets of Bogle's investing philosophy. Over the course of the subsequent 40 years, Jack evolved into the most influential proponent of low-cost, diversified passive investment strategies via indexing. The indexing industry is currently worth tens of billions of dollars and accounts for at least 40% of the assets held by the mutual fund industry. As a result, costs associated with managing financial assets will go down, which will facilitate the growth of the exchange-traded fund (ETF) industry. Jack Bogle has been an important contributor to the rapid growth of the company. The cooperative framework that the company operates under is largely responsible for its success. This framework has allowed the company to flourish without the need for mergers, acquisitions, paid advertising, or promotion. The mutual structure is considered the building block because it enables low initial investment capital and the amortization of costly investing skills over larger asset bases. This makes it possible for the mutual structure to be the founding block. Since 1980, this strategy has resulted in a significant reduction in the expense ratio, which has gone from 64 BPS down to just 8 BPS, a reduction of 88%. As a direct result of the mutual structure the company adopted, Vanguard's customers have benefited significantly. As a result of this structure, fixed expenses have been spread out over a greater value of assets, which has resulted in an 88% reduction in the expense ratio. This has led to an expansion of the range and quality of services that are available, which in turn has led to an increase in the number of satisfied customers, who have in turn invested more money in the company, which has increased Vanguard's asset base and further reduced costs. Nevertheless, the generational bull market that began in 1982 and continued into the 2020s played a significant role in the company's growth. During a time when interest rates were falling and at an all-time low, the Standard & Poor's 500 index went from a low of 102 in 1982 all the way to an all-time high of 4,796. During this time, many financial management boats were raised. After gaining a commanding advantage over its rivals in the asset management industry, Vanguard climbed its way to the top of the mutual fund industry in the United States. According to the most recent estimates, the company went from having a market share of less than 5% to having a staggering 29% share. The far-sighted leadership of Jack Bogle was essential for the management of Vanguard and the company's rapidly growing investor base. He was a proponent of common sense investing, which favored long-term holdings over short-term speculation and made use of low-cost investment strategies such as index funds and active funds. He advocated for this style of investing. He was adamantly against timing the market and was of the opinion that investing in a low-cost portfolio and keeping it for the long term was a significantly superior strategy. The inventiveness that Bogle brought to Vanguard opened up new doors for the company in terms of both product and market expansion. As a result, the company flooded the market with new products throughout the 80s and 90s. Vanguard's index fund lineup expanded to meet the varying demands of investors, and new tax laws made 401 plans an important savings vehicle for workers in the United States. Both of these developments occurred in the past decade. Vanguard was an early mover in the market for retirement savings by individuals as well as by businesses. Vanguard was a latecomer to the exchange-traded fund (ETF) market, despite the fact that it was the first company to offer exchange-traded funds (ETFs) in the early 1990s. Jack viewed the exchange-traded fund (ETF) as a significant risk and was concerned that market participants who supported short-term trading would abuse and taint the ETF, which was otherwise a reliable vehicle. As a consequence of this, Vanguard's successors were forced to enter the exchange-traded fund (ETF) industry late. Despite this, Vanguard was able to establish itself as a leader in the industry thanks to the lower operating expenses made possible by its mutual structure. ETFs have become an essential component of Vanguard's product lines, and the company places a strong emphasis on the idea that diversified index funds are more ideally suited for long-term ownership than more speculative and specialized vehicles. Jack Bogle, the man who started Vanguard and became its CEO, was a brilliant businessman and a pivotal figure in the company's rise to prominence. The success of the business could not have been achieved without his capacity to win the trust and recognition of customers. The writing skills that Bogle possessed, including his first book on sensible investment, were critical to the company's achievement of higher levels of customer loyalty and lower rates of customer turnover. The fact that Vanguard's redemption ratios have been consistently 10% lower annually than those of its competitors demonstrates the significance of savvy business practices and a culture of success in the success of the company. The Jack Bogle myth, which has been chronicled in at least 5 or 6 novels, is frequently used as the basis for the tale of how Vanguard rose to prominence. Behind the conventional account of Jack Bogle's product innovation and visionary leadership is, however, an incredible management story waiting to be told about how growth was enabled and a winning team was developed. In the early 1980s, Vanguard encountered difficulties as a result of its rapid expansion and its reliance on outdated technology. Bogle and Jack Brennan collaborated effectively in order to find solutions to these problems. In 1996, when Bogle needed a heart transplant to save his life, Brennan took over as president of the company and remained in that role for the next 12 years after Bogle stepped down from his position as CEO. Brennan reinvigorated the Vanguard management team and re-established the standard operating procedures for the company. He was an excellent manager who knew how to hire the best players, cut ties with those who weren't cutting it, and shuffle his players around so that he could teach and develop everyone. He played a pivotal role in the organization's ascent from a technological gentleman C in the late 1980s to a position as an industry leader and early adopter of the internet by the late 1990s. After switching its service delivery strategy to one that was centered on the web rather than the conventional contact center, Vanguard was able to realize a substantial increase in its return on investment. Jack Brennan also made certain that the team was cared for by recruiting capable HR professionals and encouraging the development of a can-do, win-at-all-costs mentality. Both of these things contributed to the success of the team. In the process of leading the company through the necessary steps to achieve operational excellence, he disproved the idea that low cost is synonymous with poor quality. Instead, he placed an emphasis on the significance of offering the most bang for one's buck and constantly encouraging improvement. His guiding principle was focus and discipline. The leadership team at Vanguard has always been made up of fierce competitors who have always aspired to be successful on behalf of their customers and lead a winning team. Winners were essential to Bogle, Brennan, and their successors. Many people believe that they may even bring about something resembling a cult atmosphere among the members of their team. The group was brought up with a can-do attitude that was motivated by their successes and fueled by a shared emphasis on the organization's clients or customers. The story of how Vanguard began should also encourage and inspire mutuals and cooperatives by showing how to align teams around that mission and how to concentrate on building the team and the capability to execute opportunities to the fullest extent possible. It is still necessary to have managerial expertise as well as perseverance, and it certainly doesn't hurt to have a little luck by being in the right place at the right time.